Tax brackets got your tongue? Or maybe a mild case of tax scratch fever? Or are you just struggling to understand how all this tax math adds up? Well, today we're demystifying and touching on the best part about tax brackets. I bet you didn't know there was a best part, because they're not all just about paying taxes. I'm going to show you how understanding just a few concepts can help you save some money. So if you're ready, I'm ready, so let's do this. In this video, we'll talk about how tax brackets work, define some key terms, and illustrate how tax brackets operate in practice. We have several videos ahead where we talk about various savings and investment options, but it's important that you first understand how income tax brackets work, as this will be pivotal to understanding how you might choose investment options. Many young and even older investors don't consider taxes as a part of their investment planning. However, incorporating tax efficiency into your financial decisions can save you tens, if not thousands of dollars over your lifetime, especially if you're just starting out. And understanding tax brackets is a fundamental first step in doing so. Let's start with the basics. The U.S. has what's called a progressive income tax system, made up of increasing income ranges or tax brackets and tax rates. This means the higher your income, the higher percentage of your income you'll pay, but not on all of it. This is where many get confused. If you earn more, your entire income isn't taxed at a higher rate, just the portion that falls within each tax bracket. You can think of this as a water fountain, only spilling over once each tier fills to the top. Federal income taxes apply to a variety of income types, but we're going to focus primarily on income that's taxed at regular federal income tax rates, considered ordinary income by the IRS or Internal Revenue Service. Ordinary income is classified by things such as wages and salaries, self-employment income, interest and dividend income, retirement account withdrawals, rental income, and short-term capital gains, which we'll touch on as well. Now, what are the federal tax brackets? Federal tax brackets are basically tiered income ranges, each range containing a specific tax rate increasing as income becomes greater. For example, assuming you're a single individual, your tax brackets for 2025 are as follows. Now let's say you have an annual salary of $60,000. You would fall within the 22% marginal tax bracket prior to any deductions, which we'll touch on shortly. But again, this doesn't mean you pay 22% on your entire $60,000. I'll explain further in just a minute. But first, back to the brackets. There are currently 5 different filing statuses which determine your tax bracket, among other things. Which status you utilize is based on your individual situation. There is single for unmarried individuals with no dependents. Married filing jointly for married couples filing one single tax return together, usually the most beneficial. Head of household for singles supporting any dependents. Married filing separately for married couples filing separate returns. And qualifying widower with dependent child, which is more of an exception status for allowing joint filing to continue for up to 2 years. Based on figures from the IRS Statistics of Income, this shows the breakout among U.S. taxpayers, with 48% married filing jointly, 35% single filer, 14% head of household, 2% married filing separately, and less than 1% qualifying widower. Here's the 2025 tax brackets across the 3 most common filing statuses for comparison. Feel free to pause the video to take a closer look. Clear as mud, right? Now let's walk through a basic example of how this plays out. Let's again use a single filer making $60,000 annually. As a reminder, you are within the 22% tax bracket before any deductions. But here's where people get tripped up. The marginal tax rate is the rate on your last dollar earned, in this case $60,000. But again, you don't pay 22% of the total $60,000. Let's go back to the water fountain analogy. Think of it as if your money is spilling over to each tier of the fountain to the next tier or bracket below. So as each bracket fills, it spills the remainder over to the next bracket, and so on. Starting off with the 10% bracket, the portion of income up to the top of that bracket range is taxed at 10%. The amount up to the top of the next bracket is taxed at 12%, and the leftover portion at 22%. Here's a summary of how that works out. The amount that you actually paid determines your effective tax rate, or the rate paid across all of your income. So while your marginal rate is 22%, your effective rate, in this example, is only 13.5%. It gets a little better, believe it or not. There's also something called the standard deduction. This is a fixed dollar amount that the IRS provides to all taxpayers, which makes this first portion of your earnings tax-free. This reduces your taxable income before brackets are applied. These also vary based on filing status. The 2025 standard deduction amounts for each federal tax filing status is shown here. Let's now circle back to our example, this time with the standard deduction applied. In this case, you apply the single filing standard deduction of $15,000 to your annual income of $60,000, which reduces your taxable income to $45,000. You can see that this lowered not only your marginal tax rate to 12%, but also your effective tax rate, or what you actually paid, from 13.5% to 8.6%. Pretty cool, huh? Now, there's more good news we need to call out. The IRS adjusts tax brackets annually for inflation. The bracket ranges are typically raised every year, allowing more of your income to be taxed at lower bracket rates. This occurs every year, aside from some very rare occasions historically. But sometimes there are some other unique situations where Congress steps in and makes tax law changes. A great example is the 2017 Tax Cuts and Jobs Act. This lowered most income tax rates, widened the brackets, and nearly doubled the standard deduction for all taxpayers. On a side note, this is set to expire in 2026, unless Congress chooses to renew. But I digress. Let's now talk about another important federal tax bracket that can further bolster your tax savings opportunities, called the capital gains tax bracket. The most common capital gains comes from the sale of investment assets, such as stocks or real estate, such as the sale of a home. There are two types: short-term capital gains, which are held less than 1 year, which is taxed as ordinary income, and long-term capital gains, which are those held more than a year, which are taxed using the capital gains tax bracket, which again varies by filing status, as you see here. Let's look at a quick example on how long-term capital gains can help you save on your total tax bill. Let's assume you're a single filer making an annual salary of $45,000 and you sold some stock investments giving you $10,000 in capital gains. Now let's compare long-term and short-term capital gain scenarios and how they might be applied towards tax savings. Starting with your $45,000 salary, you then add the $10,000 in capital gains, which brings your total taxable income to $55,000. Apply the $15,000 standard deduction and your total taxable income is reduced to $40,000, placing you within the 12% marginal tax bracket. Now, let's compare the difference between short-term capital gains, which is assuming you held those investments under 1 year, and long-term capital gains, meaning you held the investments over 1 year. As you can see, you save $2,400 in taxes simply by holding the investment longer and benefiting from the 0% long-term capital gains rate. As I mentioned at the beginning of the video, this is the best part of understanding tax brackets. Knowing how and when to use the various brackets in conjunction with one another can clearly have a positive impact on your tax bill, kind of like playing a fun game of tax Tetris. And just when you thought we were done, we can't forget about state income tax. Most states also require income taxes beyond federal income tax. However, there are 9 states that have no income tax, with a few exceptions for capital gains. Each state has its own brackets, rules, and deductions, which is beyond the scope of this video. But I wanted to call it out since it is a thing and you should be aware. You can research the details of your state specifically since they can vary greatly. As you can see, having a solid understanding of tax brackets can greatly help with financial decisions, and in some cases can help you avoid paying some taxes altogether. Your tax situation will vary by year, as will investment performance, so understanding how tax brackets work will allow you to make very planful decisions to help optimize your tax situation, paying the least amount of taxes necessary. The official U.S. tax code is Title 26 Internal Revenue Code and contains all the federal laws governing taxes and is said to be over 6,800 pages. But don't be overwhelmed. Tax brackets are where it all starts, and now you know the basics. To even help further your tax situation, check out our video on payroll tax deductions by clicking here, and be sure to like and subscribe so you don't miss any new content. And please share this video with anyone else you know might be interested. It's our goal to help educate others with the info they need to build their own financial success. And I hope to see you in the next one. This is AJ, your ace in the hole. See ya.